Yes. So now we are recording this session. Okay. So for everyone joining us, this is the life insurance masterclass. Um, and as I was saying, your favorite financial influencer has probably popped onto your screen, onto your Instagram page, and told you, don't buy an endowment policy. And an endowment policy is a scam, or endowment policies are ghetto policies. You've probably come across that. And you've heard also them intimating that instead of buying that education policy you were considering, purchase, maybe take up a money market fund. Okay. And from where I sit as someone who has a good understanding of both the investment side of the market and the insurance side of the market, I usually cringe. And it's a cringe coming from, that one of shaking my head because of the scarcity mentality of the people that we are encountering online who use a marketing gimmick where if I want to sell product X, and there's product X and Y in the market, then now my goal is to taint the image of, say, product Y so that people can now go, I can create demand for this product X. But even with all this noise of don't buy this endowment policy, don't buy that education policy, have you ever asked yourself, last year, I'm privy to one endowment policy, a gentleman who purchased an endowment policy where he is paying 1.5 million shillings per month. Okay, so there you go, 1.5 million shillings from an endowment policy. So this is the endowment policy that, of course, all the time we are hearing, don't purchase. I'm yet to mature as an agent to get to the levels of having clients who set aside 1.5 million. But I do know many products, even just within the endowment space, of 200, 300, 500, 787K that was still being sold last year. And anytime I look at those, I like to call them romantic figures when it comes to endowment policies. And the reason I'm starting at the endowment is because these are the staple life insurance products in Kenya. Okay, so today we'll get to look at different life products, but let's start with what is commonly purchased by our people. So every time I encounter, all these people buying a policy, setting aside 70,000, setting aside 200,000, setting aside 500, setting aside 1.5 million to go to an endowment policy, I like to ask myself, is it maybe that people assume that this person who will set aside 1.5 million shillings every month in an endowment policy, is it that maybe people think that he does not have, say, his emergency fund, say, in a money market? Okay. Is it that people think these people do not participate in the treasury bonds? I mean, all of last year we saw we saw treasury bond rates of return, the coupon rates really skyrocket. Is it that maybe the assumption is that these people are not aware of the investment opportunities in the market? Is it that maybe we think that these people do not have big time real estate portfolios? Okay, so, and I think that is one of the myths that we need to debunk today, okay? Because if there's someone out there who will go and dedicate out of his income every single month, dedicate 1.5 million and set that aside into an endowment policy, I think it's worth looking into and asking ourselves exactly what is the motivation, for this, like, why have they bought that? What is the end goal? What's the financial goal? So that is exactly what we'll be looking at today. And let's start with a very, if we can call it, like, shocking statistic about the life insurance uptake in our country. Okay, I mean, this you've probably had, insurance penetration in Kenya is just under 3%. Actually, last year we attended a regulators meeting, that is the IRA, Insurance Regulatory Authority, and insurance penetration in our country had actually dipped from the one we used to say 2.9, 2.9 all the time, it was now standing at 2.4. Okay. And I think this is so saddening for everyone who's on this call. And now, when we switch our attention to the life side, do you know where the life insurance uptake in our country is? It's at 1.2%. I'm curious to know, for those who are in this class, please tell us in the chat, okay? Are you part of the 1.2% or are you part of the 98.8%? Tell us, are you part of the 1% or part of the 99%? Yes, we see Liz saying she's part of the 98.8, or Claire saying 98.8. And the reason why I'm asking this question is, Catherine, happy to see you there, 1.2%. But we can see why we have these statistics. The majority of us, and remember, we would even say that those who join this class are the curious ones, are the ones who want to learn and change, hopefully, their circumstances and change their financial portfolios. But you can already tell, even the curious ones who have joined this call, the majority of them are still within the 98.8%. But it's encouraging to see Winnie, to see Eliud, to see Anne and Stella all lifting their hands up for being part of the 1.2%. I love to see Kenyans who have actually embraced life insurance. But this tells you, if we were to be grouped in, groups of 100, only one of us would have life insurance. And I think it's not a wonder now when you see such statistics, it's not a wonder that when we lose a loved one, what is the first thing? What's the first instinct that we do? Number one, in most cases, it involves probably forming a WhatsApp group. That's our version of GoFundMe, right? And you form a WhatsApp group so that we can fundraise. You get, because the products that are meant to be standing with us and for us when a breadwinner exits the stage, we are not participating in those products, and those are life assurance products. Okay, so it's my hope that by the end of this masterclass, we can have, for those of us maybe who are part of the 1.2%, and maybe by the end of the class, you realize that, oh my God, I'm actually underinsured, that you can you can go ahead now and pick up also products to ensure that you have ample insurance. And for those of us in the 98.8%, it's my hope that by the end of this masterclass, you'll be able now to look deep, do a proper needs analysis with your preferred financial advisor, and let's raise that 1.2%. I always look forward to the time that even that penetration will get to 15%. It will be a big win for us as a country. Okay, so as we said, today now let's go and let's focus on the importance of life insurance in wealth management. Okay, and first let's ask ourselves, because we said we want to see how wealthy Kenyans use life insurance, or the role of life insurance within their financial portfolios. So first, we need to zero in, zoom in and get to understand what is this wealth management, right? Because this goes beyond traditional financial planning, okay? It's a very holistic approach to growing, protecting, and transferring your wealth. And I hope you've gotten those three aspects of wealth management, okay? So there's an aspect of growing, protecting, and transferring wealth, okay? So when you talk of wealth management, this is basically someone having a comprehensive financial strategies that are tailored to their goals, whatever goals they have financially, okay? So they are tailored to those goals. They are tailored to their risk appetite, okay? And also they're tailored, so it's something long-term also. Remember, when you are building wealth, it's not something that we do, it's not something short-term. okay? But let's look at what are the key components of wealth management. So number one, okay, investment management. So you will notice that these people seek to optimize their portfolios for growth while they manage the risk, okay? There's also a key component of estate planning, okay? And this is where now even their assets are structured for tax efficiency and also a smooth transfer to their heirs, okay? So you will find amongst the wealthy Kenyans who may want to really see how their financial portfolios look like, how their wealth management strategies have been put together, you will notice these are the people who are really consuming trusts, for example, as a way of estate planning, okay? Because I think, and I like to say this, by the way, for everyone who is on this call, do you know that the oldest estate planning, or not estate planning, no, the oldest succession, okay, succession court case in Kenya is 46 years. And I want you to think about that. There is a family that has been locked in battle in our Kenyan courts for a whole 46 years. I mean, if that's not just disinheriting that family, you can imagine what has happened over the past 46 years. And there's a family that has been locked in the corridors of justice in our country, trying to pursue what is rightfully theirs. And to date, that case is still ongoing. Okay, so you find that for wealthy Kenyans, of course, and the people that we are zeroing in on today, we are putting a spotlight on, when it comes to their wealth management strategy, they put a lot of emphasis on estate planning. Okay, so the third key component of wealth management is risk management. Okay, and now this is where especially what we are discussing today falls squarely. Okay, so because they ensure that through their wealth management strategy, they mitigate potential financial threats and uncertainties. And if we were to ask ourselves, what are those potential, financial threats? Okay, because you should be asking yourself, what are those threats maybe that could stop me from earning my income? Because that's what we are talking about, but we'll get to see now how life insurance, the role that life insurance plays within this wealth management. And also the fourth key component in wealth management is retirement planning, okay? And this is, they are able to differentiate their investment management, by the way, also with their retirement planning. These are two separate components, even within their financial plan, within their wealth strategy. And this is because they want to ensure a comfortable and sustainable retirement income away from the mainstream investments and all. Okay, so there we have it. Four key components of wealth management, that is investment management, estate planning, risk management, and retirement planning. Okay, but now with that understanding, let us look at what is the role of life insurance in wealth management. Okay, so number one, life insurance. Okay, I see Christine. Christine, you've raised your hand. Is all well? Oh, yes. I see the slides are stuck. Sorry, I'm so sorry. I spent so much time doing the slides for you. Sorry about that. But there you have it. This was the right slide on the key components of wealth management. So there we have it. Investment management, estate planning, risk management, and retirement planning. Okay. I hope now we are on the right slide. Thank you, Buddy. Thank you, Christabel. Thank you, Christine. Okay. And thank you for raising your hand. That caught my attention. Okay. So now let us look at then, what is the role of life insurance in wealth management? Okay. And the key role, okay, let's start with number one, income protection. Okay. And basically what life insurance does within now a wealth management strategy is that it ensures a consistent income stream during unexpected life events. And when we talk of unexpected life events, there are three key risks that life insurance protects us in the event of. Number one, in the event of death, okay? In the event of a critical illness, and in the event of a permanent and total disability, okay? So those are the three key risks that a life insurance policy will always aim to protect you against, okay? And when we talk of in the event of death, especially in the event of premature death, okay? So you are maybe a parent, you are a business person, you are a breadwinner in your household, the one thing that could really affect your family is in the event that, you leave, you exit the stage prematurely, So how are they able to replace that income, that paycheck that you are bringing into your household month on month? So we'll get to look at, we'll give these points its own slide a little bit later. We'll even get to look at how we calculate income protection. But this is one of the key roles that even wealthy Kenyans use life insurance for. One of the goals is to ensure that, God forbid, in the unfortunate event that I pass on prematurely, okay, then I will have locked in X amount of money into my household so that that paycheck, can be coming into that household, say month on month, okay? Key role number two when it comes to, yes, so key role number two when it comes to the role of life insurance in wealth management is wealth preservation, okay? And one thing you will notice is that life assurance payouts are usually tax exempt, okay? So your life policy, your life payouts or life payouts for this caliber of Kenyans facilitates a tax efficient wealth transfer, okay? And it helps to preserve assets for future generations, okay? So you assure that if you have that 100M, that 50M, that 20M, that 500 million, life policy, that when it is finally honored and paid out to your loved ones, okay, if it was a 10 million payout, then it will be paid out to the very cent, okay? So they use life policies for wealth preservation. Number three, and this is something I have noted, there's a high appetite, especially amongst businessmen. Okay, so wealthy businessmen, to take up life insurance for purposes of key person or what we call key man insurance. Okay, so they're out there ensuring that their businesses, because these businesses are part of the wealth they're building for, their rightful heirs, right? So they ensure that, God forbid, in the worst case scenario, okay, in case they were to pass away, prematurely, then there is a payout, that there's money that will be injected into the business or into the organization to ensure that, one, the business is compensated for potential financial losses, okay? So, and this basically ensures stability and continued success for that business, okay? So that's another key role that our wealthy Kenyans use life insurance for, okay? Number four, to enhance their estate planning, okay? I think we've already touched on just the need, that estate planning is one of the key components when it comes to wealth management. Because the last thing you want is your family, that once you're gone, your family is locked in battles, for 5 years, 10 years before they can even reach the wealth that is rightfully theirs. Okay, so how they use life insurance, okay, to enhance basically their estate planning is that it's because it ensures a smooth transfer of wealth, to beneficiaries by providing a tax efficient way, number one, cover any inheritance taxes that may be there or any other costs that are associated, okay, with passing on significant assets. Okay, so you will always notice that within these trusts that are set up, there will always be like a proper high value life assurance policy. And this is because, by the way, do you realize that a good life cover pays within like 72 hours, maybe about 2 weeks? Okay, so you can imagine the patriarch or the matriarch, they've exited and they had that 100 million life cover, and that liquidity to that level is injected into the estate within 72 hours. Okay, I hope you actually get to see life insurance payouts. Number one, they inject liquidity into an estate, okay, and the payouts are done very fast. Okay, so number 5 role of life insurance is in business succession. Okay, and I know this comes close to what like what we were talking about, key person insurance, but let me tell you how this differs just a little bit. Okay, so for entrepreneurs, for business owners, life insurance can play a very vital role when it comes to your business succession planning. Okay, and this is because life insurance policies can be structured to actually fund a buy-sell agreement. Do you get? So this would ensure a smooth transition, okay, of ownership in the event that the entrepreneur or the business owner has passed on. Okay. So, and basically this just helps to maintain business continuity and it protects the value of the enterprise. Okay, so business succession, and this is where you will find, say, partners. Okay, you'll find two partners, they've taken a term policy, or nowadays I'm starting to see a high appetite even for whole life policies, even for purposes of business succession. And they will have an agreement that, say, in the event that I exit, this policy, maybe I've taken up a policy of 100M, I've taken up a policy of 80 million. That is actually a business expense and has been taken up, actually, it's paid for by the business. And they'll come up with an agreement such as, this life payout should be made out to my family. Okay, and at that point now they will come up with terms on how maybe now the family can relinquish their claim to the business. Okay, so we are starting to see a lot of interest around this, especially for businesses where it's a partnership. Okay, and also life insurance, one of the key roles of life insurance in wealth management is just wealth accumulation. I know a lot of us, especially for those, maybe for the many 1.2% that I saw on the wall, this could be something that that a lot of us could actually be engaged in, because as we know, the staple life product in our market is the endowment policy. A lot of Kenyans take up endowment policies for the purpose of accumulating money. You have a financial goal. Let me give you an example. Last week, so I was doing a life insurance presentation to a wealthy. When I say wealthy, yes, this one is wealthy. And for his policy and the spouse, his premiums are north of 400K. And this is now for a pure life policy because he's looking to do an income protection of about 360 million. That is for him, whatever he wants, the cover he wants to take for the family. And for the wife, she's taking about 120 million. And after we finish that, because the gentleman is a businessman, like Mogul, he's done a lot, especially within the real estate space. And when we were doing needs analysis, there's something that he explained to me. He told me there are years where he has flipped land and it has given him over 1,000%. So I hope we cannot get into the mentality of the type of people we are talking about. This is someone who would not be impressed by an 18% return on a bond, by the way. Like 18% is too low for him. So if he's thinking investment, that is too low. Okay. And so first he told me now at the age that he's at, mid-40s, he's now started to appreciate the need to do more protection. So for him now, agreeing to finally sit down, consider life assurance products, it's where now he's reached and he starts to see, number one, the need to build liquidity into his estate, like immediate liquidity at the point that he exits. And number two, just the need to do ample income protection without the family having to offload any of the assets that they've required, or having to liquidate maybe even the business, okay, in his absence, okay. But when we finished, because I was sure he would love, because I proposed a whole life cover, he loved it. And at the end of our discussion, he asked me to also get him an endowment policy. Let me tell you, I was bewildered. I was shocked. I was even telling him, are you sure? And then yes. And he told me he wants to start small. Okay. And he told me he wants to start small at 200K, okay, per month, and then build it over time. Okay. And of course, I am usually very inquisitive. So I was picking his mind, like, why endowment? And he told me the one thing that he explained to me is that he cannot even say that he's ever liquid, because anytime money comes in, that money finds itself back into the business, that money finds itself hunting for property somewhere, hunting for plots, like a huge tract of land that now he can sell. And right now, he's just looking to accumulate, okay, some money for himself for the next 10 years that will actually be just a lump sum for himself in retirement. You see that aspect of wealth accumulation? So, of course, this is the product where, that we keep hearing that, oh, the return on this, is not, is so low compared to a money market. But there goes somebody whose tax bracket is definitely in the B's, okay, asking for a cover, and actually using the words, I want to start small, then we can build it over time. And his starting small is 200K per month in an endowment policy. Earlier in this masterclass, I alluded to one of my colleagues in the industry last year selling a policy at 1.5 million shillings. I get blown away, by the way. And from how she explained how that happened is because the person who purchased that policy is someone who needs to accumulate money in the short term, in 5 years, in a very disciplined way, in a way that he cannot fail. Okay, a very mature Kenyan, someone who has maybe also probably tried different ways of, accumulating, but maybe every time they go back and trivia and they remove the money. Okay, so they just wanted somewhere where the money can be locked over the next 5 years, then he just accesses it in a lump sum. Okay, so that is a key role when it comes to wealth management. That is something that life assurance products will allow you. Also, another way of looking at this wealth accumulation role of life insurance is, especially for high value policies, such as whole life policies, okay? You will always realize that some 5K in a whole life policy, say for a 30-year-old, will be giving them, like a guaranteed sum assured, something north of what, 9M, maybe even 11M. And then maybe when you factor in the accrued bonuses over time, that estate could even go to anything north of 13 million. So, and although this is not a cash value that you can access in the short term, basically it just helps you accumulate wealth in a way that even mainstream investments? Because sometimes I like to ask, for this 30-year-old, okay, where maybe other than in a business, because I always feel that maybe businesses are the one investment, vehicle that has the potential, maybe that if it works and it works well, you could just be a Mark Zuckerberg. You could wake up and, you have an empire. Okay, but now other than businesses, life assurance products literally have the highest potential. Okay, and especially if you're using the right life assurance product, they have the highest potential of helping you build wealth and accumulate wealth over time. Okay, so now let's move to the next slide. Okay, and up to there, I'm keen to see any questions. Okay, I see there's some questions on the chat, and I see Anne, you've just asked a very good question. What's the difference between whole life policies and endowment policies? That's actually our next slide, so we'll get to look at this. And as Ngugi says, I look at it from the life expectancy perspective. No, as opposed to what? Premature death? Is there such a thing as mature death? Okay, that's Nandunda. And I want to ask you something, Nandunda. We just lost a hero in this country. Let me tell you, guys, I had become such a fan of Kiptum. I knew that young man was going to do exploits. I knew he was our next, our next champion. Like I knew he was our next goat. We are blessed with many greatest of all time, but I could, every other Kenyan knew the potential in that young man. And a week ago, we lost, like this week, we woke up to the news that we lost. I was so gutted. I didn't want to believe that we could have lost that young man at the age of 24. May God rest his soul in peace, and also his coaches. Now, and I want to throw this question back to you. Do you feel now that we have premature death? Okay, and I've seen Buddy saying, I can see Nandunda also asking, as opposed to what, is death ever not premature? Just curious about whether this is a technical term in insurance, the definition for what premature means. Ngugi saying, I look at it from the life expectancy perspective. There's an average age most adult Kenyans live to. So any death occurring before attaining that age can be termed as unexpected death through accidents, sudden illnesses. Thank you so much for that, Ngugi. That is such a great response. But yes, when I talk of premature death, okay, I think Kiptum's passing on is basically, it just encapsulates the whole notion of what premature death is. I just lost one of my clients in the past month. Lost this young man at 41. Okay, let's say early 40s. A father, young children, great, amazing husband. What would you call that? What would you call that? Life well ahead of them, children still in school. So when we talk of life assurance, protecting you in the event of premature death, before you even finish, say, your responsibilities, before you've lived that full life. Okay, we always say maybe like a full life is up to what, 70, and anything after that, ni marupurupu ya Mungu. Those are your bonus years from God. Okay, but anything especially happening before then, would we term that as a fully lived life? So Nandunda, that's where I was coming from with that term. Okay, so what I meant is, I think all or most death is unexpected or premature, whether 24 or 89. Okay, let's not, then you can hold on to that, but I think now you understand what I mean by premature death, especially at 24, at 41, possibly at the height of your children still going to school, at the height of your spouse, still heavily dependent on your income. That is what I'm referring to as premature death. And I see your comment, Christine. Okay, so I'm always very animated, so let me see if I can keep the voice stable. Okay, so now I want us to go on now to the next slide. We will now be looking at the different types of life assurance policies. Okay, types of life insurance policies. And we had also gotten this question on the chat. There was a question on what is the difference between endowment policies and the whole life policies. But even better yet, we will also get to look at term life policies. Okay. So endowment policies, as we said, these are the staple life insurance policies in our market. Anytime you hear someone says, I have an education policy, maybe I have a savings plan with company Y, I'm saving for the next 10 years in this life cover, and then on year 10, it will pay me. That is what we call an endowment policy. And I hope for those of us who are on this call, and I'm keen to see, especially on the chat, okay? Especially if you have an education plan, do you understand that your education policy is a life insurance cover? Okay, I'm keen to see our 1.2%. Please get busy on the wall. Please tell us, do you understand that your education policy or that savings policy that you've taken is a life insurance product? I see Catherine saying, Nandunda saying yes, good. Winnie, fantastic, fantastic. Patrick, Stella, fantastic. Irene saying no, how? Okay. So now let's look into this, Irene, and you'll tell us, the goal is to see if your education policy, whatever you are using as the education policy, will have these features. Okay, then now you'll get to understand it's actually a life assurance product. Okay, so basically, an endowment policy is a type. So we have the larger life insurance umbrella, okay? And under life insurance, we have now different types of policies, okay? So now this endowment policy is the type of life insurance cover that marries savings and protection, okay? So there's a saving element to it. You know that, yes, I'm setting aside 10K or 20K or 30K or even 200K every month, okay? And then at whichever, at maturity, okay, I will get my maturity payouts, okay? So that's one of the main components of an endowment policy. But also, even as I am doing this, and I am waiting for my guaranteed payout, at whichever point maturity happens, I am also enjoying life insurance benefits, okay? So I know that in the event of death, I know that in the event of critical illness, and I know that in the event of disability, I am covered, okay? And some of the benefits you get to enjoy, say in the event of death, for example, if I pass on prematurely, I'm assured that in most cases, there's an immediate payout that's done to my family. So there's an amount that's paid out to my family. Then there's a waiver of premium. So maybe if it was to be a 10-year policy, and I've passed on year 2, okay? So there's an immediate payout made to my family. Then they are told, going forward, do not pay premiums, okay? So there's a waiver of premium. And on year 10, the anticipated maturity payout is now made to my family, okay? That is how most endowment policies look like in our market. We definitely do still have some endowment policies where if death happens, it just pays everything at a go and it ends at that point. But most endowment policies will do an immediate payout, do a waiver of premium, and now pay the final payout and the lump sum at maturity. Okay, so what sets out endowment policies from most other insurance products is that maturity payout. And endowment policies get too much flack, guys. And I like to remind my clients that, one, think about insurance. For those of us who have motor insurance, please tell us on the chat, okay? when did your motor insurer, okay, the insurance company where you buy your motor insurance, when did they ever come and tell you, Jay, you have been so faithful, Elsie, you have been so faithful with us, we will give you back your premiums now that you've not had an accident? He tells, because in essence, that is how insurance works. Insurance usually covers you for a particular period of time. If the insured risk does not happen, then you don't get your premiums back. You don't get the money you gave them. And look at this type of life insurance product where literally you are giving them the premiums month on month. They are investing this money and giving you a return. And by the way, I know a lot of people say endowment policies have poor returns. I think you are just going to the wrong policies. There are some amazing endowment policies in this market, by the way. So this money, first you're guaranteed your money back, then you're guaranteed a bonus on it or interest on it. But at the same time, you're also enjoying life insurance benefits. And at maturity, they give you back all this money. Which insurance product does that? Okay, because for those of us, maybe who have medical insurance, those who have motor insurance, that does not happen. If you purchased your motor cover, you paid 100K for your premiums, by the end of the year, you've not had any accident, your premium to inaenda. Next year, you renew again and you give them another 100, some 95, maybe because the value has come down. And the drill continues. I once engaged my fellow co-host in this session and my co-founder at the Money Village. I was once speaking with her father, and he mentioned that for all the years he's been driving, all his years being on the road, and he started driving as a young man in his 20s, he's never made even one motor insurance claim. Just think about it. And I just try to imagine all the premiums that he's paid over the years. And at no point, will you ever get back the premiums back? So in essence, I like us to understand how insurance works. Insurance, you pay the insurance company a premium so that they protect you from risk A, B, C, and D. Okay? And when those risks don't happen, you don't go asking for your money back. But with this endowment policy that tends to get so much flack in our market, this is actually a policy where you give the insurance your premium, they guarantee you a particular payout. For example, for education purposes, they will tell you, we will give you 10 million when your child is joining university. But they also assure you that should that happen, your child will still go to that university. Okay, should you be diagnosed with a critical illness, number one, we will pay you a lump sum, because we know you're going through a hard time. Okay, and after that, after giving you a partial payout, we will do away with all the premiums that you're supposed to be paying month on month. So that means going forward, the insurance company is literally paying those premiums on your behalf into that policy. And at maturity, your child will still go to university because we will honor the 10 million payout as guaranteed from the word go. And other than the critical illness benefit, they also give you a permanent and total disability benefit. That God forbid, should you be out there maybe walking and you're hit maybe by a border, should you maybe be involved in a road accident or anything like that, should you be getting out of the bathroom and maybe you sleep and you become permanently and totally disabled, we will make a payout in the short term. We will waive the premiums and we will still ensure your child goes to university. That's the promise of endowment policies. Okay. Now, let's look at term policies, because I hope now we have a good understanding of how endowment policies work. And I think it's for this reason that every time I go online and find a lot of people who do not understand the value of these policies. That's why I'm always shaking my head. People who don't understand just how disciplined, this kind of policy helps parents be? You know, we are in an environment where there are so many expenses that are fighting, literally fighting for that income. You know, your income comes in and the expenses left, right, center. But in most cases, unless maybe you just take that money and hide it, you know, you throw it, you know, you automate that direct debit, you automate that standing order, you automate that check off from your employer. If that money probably lands into your bank account, the likelihood that even if you have the best intentions of saving for that education for your child, it just becomes hard because there's so many competing needs. Okay, and the income just doesn't feel like it's enough, okay, to cater for everything. Okay, so that is what endowment policies are. Okay, so now let's look at term life policy. Okay, so by a show of hands, please, on the chat, how many of us have an employer provided life insurance policy, what we call a group life cover? How many of us have group life insurance? And as you wait to see, just on the charts, you will see that those group life policies, they fall under what we call term life policies, okay? And basically a term cover, okay? Yes, Margaret? Oh, good, okay. Okay, I see. You're raising hands to say yes. Bridget, I see you. Thank you for participating. A term policy is basically a type of life insurance cover, okay, that will give you protection for a specific period of time. So this can be 10 years, it can be 20 years, some will go up to 25, others 30, okay? And it ensures that if the insured dies during that time, when that policy is active, then the death benefit is paid out, okay? So let's say you take a 10-year term, okay? And God forbid, on year 6, you know, the policyholder passes on. Okay, then now that means that that policy pays out. Okay, but please note, this policy lapses and in most cases has no value if the insured lives beyond that period. Okay, so you took a 10-year term and by year 10, you're just healthy, you know, you're healthy, you're alive, all is well, and that is what anyway we pray for. With a term policy, you just see your premiums, you just tell your premiums, Kwaheri. So this is very much like now the motor policies that we were talking about. The medical policies, the home insurance, etc. You know, term life insurance is usually honored if the insured risk happens within the period that you have taken up. Okay, if it happens after that period, then there's no payout. So with term policies, in most cases, say if you take a 10-year term, it means that if you're still well and good in year 10, then maybe you just renew and take another term cover. Okay, so that is term assurance. And I hope that is clear. We'll get I'll get to take Claire's question shortly. Yes, so that is how term assurance works. So if you've ever purchased a mortgage, if you've ever maybe taken a car loan, taken a mortgage, you know, taken even a loan from your circle, you will always notice there's some insurance you pay for. There's actually a life insurance component in your loan. Okay, so that insurance that you're paying for in those loans, that credit life, that's actually a term product. Because what happens, you know, after the 10 years or 15 years, once you're done with paying your mortgage repayments, you get Sinaisha too, right? What happens after the 5 years or 3 years or 4 years after you're done with your car loan, right? The insurance company will never come back and tell you, here are your premiums. Do you get that you didn't pass on during? No, they don't do that. Okay, so those are term policies. And even employer provided group life insurance, that's a term product because, as you know, it only covers you while you are with that employer. Okay, and then after that, anytime you exit, whether it's at retirement, whether you're leaving for another employer, it ends at that point. Okay, so now let's go to the last category, whole life policies. Now, this is probably one of the most exciting discoveries that I find a lot of clients when they discover whole life and proper whole life and what whole life can do for families. This is a game changer in our financial portfolios. Okay, and this is the same policy I was telling you for the clients onboarding for about 360 million as an income protection plan. This is actually the product he's using. And I need to give a disclaimer at this point. If you follow financial influencers, insurance agents, say from the UK, from the US, you'll hear them, telling you, no, buy term, don't buy whole. That does not hold water in Kenya. Please, let's appreciate the differences in the different products that we have in different countries. And I will tell you why. A typical whole life cover, say in the US, is 8 to 15 times more expensive than a term life policy. You hear that? So literally, whole life policies in the US are like a preserve of the ultra wealthy, like the super, super wealthy, by the way. And that's why you find that the uptake of whole life policies in those countries happens like in the late 50s. It's like when you have acquired so much money, that's when you can finally afford it. Okay? In Kenya, this is different. I can show you that even the best whole life products in this market is literally, sometimes you'll compare it with the term policies we have in the market, and it's even like cheaper in terms of pricing. You'll get more value for that product even compared to what you would expect from a term product. So that whole thing of buy term, not whole, does not hold water in Kenya. We have fantastic whole life policies. But from that bad whole life, okay, I hope it already tells you that this is a product that stays for the whole of your life. Okay, so this is permanent life insurance coverage. Okay, so it will cover you for the rest, for your entire life, whether your entire life is 2 months, okay, whether the whole of your life happens 10 years from now, whether it happens 70 years from now, this policy will stay in force until whichever point now you transition. Okay, so this is a policy that you can say in the short term, okay, I will use this policy for purposes of doing income protection. But in the long term, okay, this policy is actually for inheritance planning, okay? I like to say different whole life policies, even within our market, have different features. So you need to also shop around. You need to ensure that the person showing you or proposing a whole life product gets you the right product. But let me just allude to some of the mind-blowing features in the best whole life product in the market. Number one, a traditional whole life cover would need you to pay premiums for the whole of your life. So that means if you live maybe to traditional whole life policies, you would have to pay, even if you live up to 90, your agent is still knocking, like penny premium, pay premium, it's filed, okay? But in our local market, the traditional whole life policies we've had, you'd have to pay premiums until you're 75 or until you're 80, okay? But we have seen the introduction of a whole life policy where you get to choose how many years you will contribute your premiums, from as low as 10 years premium contribution, okay? So you can say, I will only contribute for the next 10 years. On year 10, you get a waiver of premium, but that product still stays in force. It's still part of your estate and will pay out at whichever point you transition. In my opinion, asking Kenyans to pay premium way beyond the age of 60, especially after retirement, is borderline trapping us to failure. Okay, so yes, when I see a product that gives us flexibility of premium payments where people can choose 10 years, 15 years, 20 years, or maybe up to the age of 60, up to the age of 65, that already tells me that is a product that is responding to the unique needs that we have in our market, okay? Also a whole life cover that has an inbuilt inflation guard. So if you ask your financial advisor, to shop for you a whole life policy, please ensure that it has an inbuilt inflation guard and your premiums are not increasing year on year, because let me tell you, that's another trap. You can imagine in your 30s or at 35 and having to pay maybe premiums up to 75, that's a whole 40 years. And your premiums increase at 5% or 10% every year. It will become unmanageable in just a few years' time, most likely. The highest probability is that you'll be unable to keep up with the premiums in the long run. Okay, so anytime you come across a product that will give you an inflation guard and give you flexible premium payment terms, I am sure you'll be with the right underwriter, and I would give a go ahead, like I would tell you, yes, you've gotten it right. That is if you're considering a whole life policy. But now, for the question we had gotten on the wall, that is the difference between endowment and whole life policies. Whole life policies are for purposes of income protection and inheritance planning. These are very high value products, okay? On the other hand, endowment policies are for accumulating cash value, accumulating money for a specific, financial goal, such as saving for school fee, building a university fund, for your child's school fee expenses, and so on. Or even supplementing your, is it supplementing or complementing? Complementing your retirement needs, okay? Was it last week? No, earlier this week, I was having a chat with one of my clients who's based somewhere in Europe, and he told me he just wanted to start setting aside some 30K, maybe for the next 15 years, so that it could complement whatever he's doing on the side for his retirement needs, okay? And by the time he came and he was describing it, because he was calling it, when he was chatting me on WhatsApp, he told me, I had, there's a term policy that I can set money aside for the next 15 years, then I get it at the end of 15 years. Do you get? So for him, and even as we were doing needs analysis, what came out squarely for him was he wants a place that he can set aside money in a very disciplined fashion, and where that money will be set for X goal, and his goal there is to get a lump sum in retirement, a tax-free lump sum in retirement. Okay, so before we move from this slide, I want to take a few questions on the chat. And Claire is asking, I have a question on the endowment policy, such as education policy. When filing tax returns, one is asked about any life insurance policy. You mean to tell me one should tick yes if they have an endowment policy? Yes, Claire. An endowment policy, an education policy is a life insurance policy. And that also tells you that as long as that policy is 10 years and above, you are eligible to a tax relief. So if maybe this is not done at the employer before they run the payroll, you can actually ask for that tax relief refund check from KRA. Okay, we can always pick up that discussion later. And also for everyone who's attended the class and everyone who also registered for this class, I will actually send you the steps on how you can go about asking for your tax relief refund. I know a lot of us, okay, especially those who are not in formal employment, where the HR can actually do that for you. We tend to ignore this. So we never even declare that we have these life products. We never go for our 15%. I hope you know that you're eligible for a tax relief refund of 15% of the premiums you're paying, up to a maximum of 5,000 shillings per month. Okay, so depending on the premiums that you are paying month on month, okay, this would mean that you could be having like a tax relief refund check of 60,000 shillings year on year. And I know the other question is usually, Charlene, will KRA really refund? Yes, they do. You have to try, you have to do it for you to confirm if actually they do. So please don't write yourself off or just assume that they won't. But I will get to share more details on that with you. So, and I see Mahmoud asking if he can call after this session. Yes, Mahmoud, you may. Let me drop you my number on the chat. Yes, but you may call after this session. Those are my direct numbers. And Anne Jerry is saying, yes, they do. I have got my KRA refund. Thank you for that testimony. And tax relief refund, you're eligible as long as your policy is 10 years plus. So now we move to the next slide. Okay. So I want us to ask ourselves, as I alluded earlier, we would get to look at income protection through life insurance. Okay, because even as we looked at all the ways and the key different roles that wealthy Kenyans are using these life assurance products, for within their financial portfolio, we also need to bring the message home to ourselves. Okay, and this does not mean that you're not wealthy Kenyans. We are. At ICC, we are wealthy Kenyans, but we also, in case there are those of us who have not yet figured out just what can this life assurance product do for me. So if you are a business person out there, if you're an entrepreneur, now maybe it's time to look at this key person insurance. It's time to look at how can this life insurance do for me business succession. Okay, if you're out there and you're thinking, I need to see which life policy would help me accumulate, wealth, so the goal would be, is it maybe for purposes of inheritance, or is it for a defined short-term financial goal, maybe such as education? Then now you choose the right product. But one of the key roles, and the key role for life insurance has got to be what we call income protection. Okay, so I want us to spend a few more minutes looking at exactly how does life insurance help you do income protection. Okay, and before we even go into that, as I take a short water break, this is a reel that's actually on my Instagram page. I'll play it. It's a short one, 1 minute, 30 seconds. Please, let's pay attention. And for those of us, I know most of us have either interacted online. I do hope that we are connected. My handle is at Mama Bima Kenya. And if not, please let's connect today. But let's first look at how do we do income protection through life insurance. Ooh. Let's give it, okay. I want I want us to give this another try, and then you get to tell me if you will get if there's audio, like you'll get to hear. In case you don't hear, maybe what we can do is, as we send a follow-up, email after this call, maybe next week, we'll also get to share a link to this. But now, please tell me if you will get to hear this reel. Okay, thank you, Poleni-san, about that. I still see that you cannot hear, so we'll get to share this part. And even before sharing, let me take you through what's happening in this reel, okay? So I see there are a few people in the, I need to admit a few people into the call. So we have a client here, and I hope I'm audible now. Can you hear me, everyone? Paul and Gugi, I am explaining this reel. I had added it here. It was a labor of love, but it's not working. So let me take you through the reel. I have a client here called Kiteme J, and Kiteme is 37 years old, okay? And Kiteme takes home a salary of 300,000 shillings a month. And I was saying, for him to be able to do income protection, Kiteme needs to take a life insurance policy that is 10 times his annual income. So if every month Kiteme takes home 300K, okay, that means annually, this is equals to 3.6 million shillings. I hope you're together up to there. So that's his annual income. But Kiteme needs to go ahead and buy a life policy that is 10 times this annual income. So what is 10 times of his 3.6 million? It goes to 36 million shillings. Okay, and at 37, if Kiteme was to take a whole life policy where he's paying his premiums for the next 20 years, his monthly premium will be 20,332. Okay, and here, please note, I have not even factored in the inflation guard or the bonuses that comes with this particular whole life policy. Okay, so let's just start with whatever is the guaranteed sum assured, which is 36 million. Okay, so now, God forbid, if Kiteme was to pass away prematurely, okay, and 36 million is paid out to his spouse, all she would need to do is look for an investment giving her a 10% return, net return. You will notice that I like to work with, I like to project with low returns. I know we are in unnatural interest regimes of 18% in bonds. So you can imagine if, say, this payout was to be made in such an environment, the return could even be way higher. But I like to work with, to project with, like where you can look historically and say a 10% is a very safe interest projection to use, because even if you were to look even 10 years ago or 5 years ago, bonds, even maybe the taxable ones, like the fixed coupon bonds, if you could get maybe a 13, 12% bond, it could still give you the 10 net. Okay, and for the infrastructure bonds that were still being issued back then, you could maybe get lucky and maybe get a 12%, 12%, 12.5 thereabouts. So that's why I like to project with a low interest rate. But if Kiteme's house is paid 36 million and she invests this money in a 10% instrument, net return, this equates to 3.6 million shillings interest every year. Please note that 36 million is invested somewhere. The principal is preserved, but that principal is giving her a return of 3.6 million every year. And that 3.6 million interest every year, if divided over the 12 months of the year, is equivalent to what Kiteme was taking to his home every month when he was alive. It takes us back to 300K. And ladies and gentlemen, that is how you do income protection. I know in other markets, they will always tell you, use the dime method. Why I don't use dime method in our market, and I'll take you through the dime method for doing income protection, is because in our market, literally every mainstream debt that you take, whether it's a car loan, whether it's a mortgage, all those they already have credit life insurance. So if you have a mortgage and you pass on, that is already catered for. your family, as long as, like your family watakuja wanyang'anywe nyumba, because there was already life insurance in it. Your bank or whoever was the financing institution, they already either have like a bank assurance department and they already sold that insurance to you. Okay, so you find mainstream debt in our country already has credit life insurance embedded into it. So that's why for me, the DIE method, which stands for debt, income, mortgage, and education expenses, does not really work for us. We can comfortably work with a rule of thumb of 10 times your annual income. Okay, and basically that is what we used here in this illustration, where we went for he's earning 300K, and now we look at what is 10 times that. And I want us to take maybe some 2 minutes. I want you, and this is like what we used to call, it's a hypothetical situation. You don't need to share this on the wall, but I want you to work out what your 10-time number is. What is that 10 times your income that maybe you would want to lock in for your financial dependence? Okay, like how much income do you have per month? Please multiply that by 12 to get to know what is that annual income, and then multiply that by 10. Okay, so your income times 12 times 10, and then I want you to ask yourself a question, okay, especially for our 1.2% percenters, if I may call it that. Our 98.8, by the way, I know you're already super underinsured. There's zero insurance there, okay? But for those who are within the 1.2%, okay, once you arrive at your income protection figure, please ask yourself, am I underinsured or do I have enough insurance? Because the tragedy of how we do life insurance in Kenya is that I take the wrong products. My goal is to do income protection, and I'm paying maybe 20,000, just like Kiteme, but my 20,000 is only affording me maybe even a death benefit of 3 million. And I keep saying, I am insured. I have life insurance, you get. So in the unfortunate event that I exit and my family is paid 3 million, my surviving partner is left at a huge disadvantage, wondering, how will 3 million shillings do income protection? Yet she would have needed about 36 million shillings. Okay, so I hope you've done that exercise. And now I want us to do an exercise where the first 3 people who will answer correctly, actually get to walk away with some really amazing, let me see, what merchandise do I have? I have notebooks. I have some key rings that are also a nice spotlight. And yes, last evening I actually won some mugs, and also, yes, I have some good merchandise for the first 3 people who answered this correctly. So Kiteme was paying 20,332. I need you to get your calculator out. Okay, I hope you have your calculator out. Kiteme was paying 20,332 shillings. Okay, so, and over the period of 20 years, Kiteme will have, so how much will he have contributed over the 20 years? That is all I want. That's just the figure I want you to put on the chart. The first 3 people who will have done that get to walk away with a prize. Emma, you guys are good. Betty, Betty, you are too ready. So this is Betty. And so Betty, you are our first winner. Let me first confirm. I had not calculated this. This one was just, let me first confirm if that's the correct number. So it's 23 by 12 and by 20. So it's 4,879,680. So yes, Betty, you have won. You are our first winner. We also have Leonard. Leonard, you are our second winner. And we also have Mudoni, Margaret. So you are our third one. So what we'll do is, after this session, kindly, you will chat me on WhatsApp. Now, what will be the proof that you are? Okay, but anyway, I know we are good people. So please chat me. I've dropped you my WhatsApp number so that we can organize. And and I can see Anne just laughing at herself, but to everyone else who sent in the correct number or who attempted, let me honorable mention to Irene, to Joy, to Kelvin, to Caroline. Carol. Okay, I don't know how Caroline, how did you arrive at your 406, 640? I'm keen to know that. To Claire, to Anjeri, to Osborne. Osborne even put the commas between the figures. You did a good job. Diana, you put the comma at the wrong place. To Christine, to Bridget, Louisa. Louisa also keen to know how you arrived at that figure. Mahmoud, Brenda, Joanne, and Anne laughing at herself. And also to Robert, great job. I see Irene saying she was sad. Let me see. Irene, okay. Oh dear. But on the chat, Irene, you came in after Betty, Leonard, and Margaret. Okay. So, but you also did, okay, let me see if we could make any concession to that. Okay, look at everyone sent in at 10:25. I'll open just a but yes, that's it. And I think, and I want us to do some quick math, especially because I want you to realize the kind of figures when we are talking about wealth accumulation through a life product. Okay, this product that Kiteme has at 36 million annually, no, at 36 million guaranteed sum assured with a 2.5% inflation guard, it's earning a 900,000 bonus year on year. In 20 years, that will be an 18 million bonus. If you add that to the guaranteed sum assured of 36 million, that's 54 million shillings, built from what are they called? Premium contributions of 4,879,680. And if you're in this call, please let me ask you, why is our life insurance penetration in this country at 1.2%? Because I only want to believe it's maybe because we do not know what products are in this market and what kind of what kind of change that this can do for you within your financial portfolio, and especially for those of us who have financial dependence. Okay, I hope you get to see. And sometimes I usually post these things on my page, especially on Instagram, and I get a lot of people say this is too good to be true. And this week I actually got one gentleman who told me this is too good to be true. And I think I was so tired. I just asked him, sasa unataka nikusaidie aje? I don't come up with these numbers. Like, these are actuarial numbers that have been crunched. All I'm using is a calculator, like an actuarial calculator from company X that they've given us to be able to sit down with a client and tell you that 10K will give you this much life insurance coverage. Okay, so please, life insurance is high value type of insurance. We have very high value policies too. Okay, so please ensure that you are using the right product. Okay, the right product for the right, to meet the right financial goal that you have. So if you're talking of income protection, if you're talking of inheritance planning, a whole life policy would do very well. If you don't believe in whole life, then you could actually go for a term product for purposes of doing income protection. If your goal is now to just save in a very disciplined way for X number of years, now that's when maybe your endowment policy would come into play. If your goal is to save and you want that money to come to you, you do not just inheritance, then an endowment plan would do for you. And please remember, it does not hurt to have the different types of life policies. I have clients who literally have endowment, for example, maybe for education, most used for education. They have term, because in most cases, whole life will not give you ample disability coverage. You'll notice that a disability, the permanent total disability coverage in a whole life will go up to a maximum of 20 million. I have a client, for example, who needed about 60 million coverage. That's the least she was willing to do. So even after purchasing her home, she still supplemented the whole life coverage with a term policy specifically to raise her accidental benefits. Okay, so you can actually have the different types of life assurance products. Okay, so now let's move to the next slide. And we are coming to the end of our presentation, and I want us to have a few case studies. And this, I was so lost sending this slide. I was wondering, what do I call this? So I named this case study one as Super Dad's Legacy. Okay, and a story is told of a gentleman who took up an education policy in April of 2022. Yes, April of 2022. He was paying 75,399 into that education policy. And unfortunately, this gentleman passed on 3 weeks later when going to work in a road accident. And when the insurance agent was looking for his wife so that they could do the claim, he needed her to fill the claim form. She was so angry because one, she didn't understand this product. So she was wondering, does he want to give me back the 75K? Like, ananisum to give me back 75K. Okay. And she was really blown away to see that that policy actually paid out a 10 million payout from the 75K. And please note, I am an insurance agent. Maybe because of time and because of the work that I do day to day, and because of what I also encounter in my day-to-day work, because I do encounter a lot of losses, whether it's, my client, either a client passing away or a critical illness diagnosis. I tend to be comfortable talking about this. Okay, I still do understand that talking about death in our society for a long time has always been a taboo subject, but I do hope that we start maybe just being a little bit more comfortable in just planning maybe for our afterlife, okay? Because this is one of those stages in life that we know are very guaranteed. We must all pass through that, okay? So a 10 million payout from a premium of 75,399, one payout. If you understand how life insurance works, by the way, that is life insurance for you. And every time I still come across our financial influencers, because I keep going back to this, anytime I see, that young gentleman, writing crazy things on X, or is it Twitter, or, a reel on Instagram saying, you continue, instead of buying endowment, do MMF. I keep wondering, when will we get over that scarcity mentality where people need to realize that you don't have to make Kenyans, like fear one product to sell the other. By the way, Kenyans have money. Just respond to their needs. Listen to what their needs are. Listen to whatever their financial goals are, and then show them all the products that are in the market. And now give the client also the choice to choose. Okay. And also to understand the difference. And by the way, I'm probably one of the agents with some of the biggest portfolios in this market for money markets. I do distribute money markets, but I always ask myself, for this super dad, who did 75,399 in an education plan, it paid 10 million. what would that have been if it was in a money market within those 3 months? Not those 3 months, those 3 weeks. And I will leave that as a rhetorical question. Okay. So case study number 2, let's talk about this super daughter's legacy. Okay, so this happened recently. The claim, I actually did this claim on Friday last week. My client had received her money by this past Monday. I know a lot of people wonder, is that how fast claims are paid? Yes, we do have a lot of underwriters where, like especially the smaller payouts, maybe for last expense policies, in 24 hours, at most 48 hours will be claims are honored. The discharge voucher actually came out on the same Friday, sent the claim in the morning, maybe at about 7 something. By 9:26, 9 something, I had gotten an acknowledgement, it was being worked on. And by 1 p.m. in the afternoon, I had gotten the discharge voucher. It's actually my client delayed to sign and share her bank statement. But yes, she got paid this Monday. And for this super daughter, her legacy in this was she's had a tough time. She lost a parent recently. And being a businesswoman, she had a hard time also getting back to back. And just that injection of money, to her, especially having after, doing a really amazing send-off for the parent, it must have pinched financially. You get, but also getting that last expense payout because she actually took a chance and purchased this policy literally 1 year before. Okay, I remember we onboarded her in January of last year for our last expense, where she included her parents. Okay, so that's case study number 2. Case study number 3, this usually probably one of the hardest and maybe also one of the biggest testaments for me as an agent, and one of those things that remind me why I do what I do. People will call it super husband's legacy. And just seeing these amazing, amazing clients diagnosed with a critical illness, and just the joy that you're able to play, a role in ensuring that when that CI diagnosis comes in, you're able to just alleviate the financial stress the family is going through because there's a payout from the critical illness. And unfortunately, when the ultimate battle is maybe won or lost eventually because the client succumbed, now that major payout, the death payout that allows that family to have about 450K per month in income, okay? I think for me, this case study number 3 for me is basically talks to the to just what life insurance does, because sometimes we don't have the time. We never know what plans God has for us. We do pray that we get to live a long life, we get to raise our children. But one of the realities of life, and especially as maybe we adult up, as we get children, is one of the realities is we could, maybe there's an illness lying ahead. Or maybe we won't get to enjoy maybe those bonus years. And if that happens, I would want to ensure, even personally as Charlene, I would want to ensure that I don't leave my Joe and my Daniela out here struggling. You get, I don't leave my mom, who literally I take care of, and my nephews and nieces, I wouldn't want to leave them out here without school fee and the monthly stipend I'm able to take home month on month. Okay, so I would say this case study number 3 for me is evidence of just what life insurance can do, especially the right life insurance product, the kind of financial safety net it injects into a family when a breadwinner passes on. Okay, and that's it. I would say this is where I want us to bring this class to an end, so that now I can invite Lynette back for a Q&A. But if there's something, I know we did our hypothetical where you got to calculate your numbers. By now, you know whether you are underinsured. For those of the 98.8%, you are already at zero. There possibly needs to be work done around that. Okay. But and for our 1.2 percenters, now they know whether they are underinsured or maybe they are using the wrong product and hoping to achieve a different financial goal. It's my hope that this class has just given you sort of like just a better understanding of what life insurance can do for you, of what these wealthy Kenyans are doing with life insurance. A few years ago, just before COVID, we had a tycoon person from a road accident. And unfortunately, the administration of his estate was dragged into court. Okay. And now, because of it going to court, we got to see some of the, like how the estate was. And one of the things that felt for me is that out of an estate of 1.2 billion shillings that was left behind for his heir, 389 million shillings was a payout from a life insurance policy. Do you hear that, guys? A 1.2 million estate, a 1.2 billion estate left behind as an inheritance, and 389 million being a life insurance payout, 60 million being a pension payout. And that tells you this gentleman had over 1/3 of his estate in life assurance products. Okay, so I think that was a peak. It was one of those revelations from Kitab I realized that, for people who know what the different life assurance products can do for them, they ensure they buy the right products. But yes, a life cover will help you build wealth. It will help you accumulate wealth. It will help you also do protection. It will help you do that income protection in the event of death. It will help you do income protection and preserve your wealth in the event of a critical illness. It will help you preserve your wealth in the event of disability. Okay, but I think we've also gone ahead and seen that these wealthy Kenyans have also seen the opportunity of ensuring that their estate continues. Okay, their businesses continue even in their absence. Okay, so it's my hope that, and I want to stop sharing now my screen. It's my hope that we've learned something. You have something to take home. And now we could open this session. Lynette, I invite you back so that we can open the session to a Q&A. Lynette, you're muted. Oh, I try and unmute you. Is it? What did I do to you, Lynn? I'm sorry. Let me see if I can unmute you. I don't know how to do this. Lynette. By the way, Lynn is my co-founder at the Money Village, and she put together, she actually curated this conversation. She's the one who pushed me and told me, Mama Bima, you need to do this early in the year. So thank you, Lynn, for making this happen. So please take over.
Okay, thank you everyone who's joined in for the session. I'm sure most of you, or not all of you, have learned so much in relation to life insurance. I've shared Charlene's number on the wall. So anyone wants to reach her, you can go on and reach her after the session. But before we end the session, there are some questions which people had shared once they were signing up. So we'll try and go through some of them because most of them have been answered through the call. So the first one is, who is life insurance recommended
Lynn, I think, is it me or has Lynette hanged? Lynn, I think.
Am I back?
Yes, you're back. Good.
Okay. The first question says that is asking, who is life insurance recommended for?
So life insurance, I would recommend a life insurance policy. Number one, someone who has financial dependence. Okay. So if you have someone who depends on your income, number one, if you have an income, number two, if you have people who depend on your income. And let me tell you, sometimes this does not mean now that stay-at-home moms should not have an income. Okay, so it's not just about income, it's also the value that you bring. So you could actually be a stay-at-home mom, but what? You're the one who probably takes care of all the affairs within the home. In your absence, your spouse, or maybe you're a stay-at-home parent, let me not say stay-at-home mom, you could also be a stay-at-home husband, maybe. I'm yet to see one, but in your absence, it would probably mean that maybe there needs to be what? Maybe a tutor in that house, there needs to be a nanny in that house, then maybe it even needs to be a driver to drop the kids to school, or school bus expenses being added to the equation. So sometimes it's also good to look at the value that you bring in economically. So if you sit down and see, one, I do have people who depend on me financially, then you need life insurance. But this is also what I say. Start small. You will build it over time, by the way. And also start from a point where you can commit to the premium. Because if there's something that makes Kenyans angry with our business, we start without, because maybe my cousin is an insurance agent. We met over Christmas and she told me she was about to be fired, or, so you did a Weishe buying. We can't be those people. We cannot afford to do Weishe buying when it comes to life insurance. So make sure by the time you're purchasing your life insurance policy, you really understand the commitment you are going into. But trust me, with the right life cover, you will be happy. So financial dependence, business people, today now we've also gotten to see that this is a product for people who are running businesses, either as key person, okay, or for purposes of business succession.
Okay. So what if someone is just out of uni and has heard about life insurance and now they're planning for their future and they're like, okay, I want to take up a life insurance cover, but at the moment I don't have beneficiaries. So at the moment I don't have dependents who I can put as my beneficiaries. So can I put my parents as my beneficiaries? Then once maybe I get children, I can now rewrite it again and now include my children. So I start early because I believe the earlier you start, the more affordable it is. So this is someone who's considering, okay, I want to start at like 23 because I know it's affordable for me at that point. So can I put my parents then? Once I get children, I can now put my children in it as the beneficiaries.
So, and that is what we call endorsing a policy. Yes, actually, for most people when they're starting off, especially young men, they have something for nominating their moms as the beneficiaries. And after some time, you'll see him now coming and saying, Shalina, I want to endorse my policy. In most cases, maybe mom at first was at 100%, and now you'll see after some time, mom maybe goes to 30%. There's a new spouse, now she goes to 70, like that. So yes, you can actually endorse your policy over time. And also for young people, maybe at that point, you may not be thinking that I want a whole life cover. You could even start maybe with the endowment, or you could even go now for like a standalone critical illness cover. You could be more inclined towards going maybe for something with an accident benefit, because sometimes it's good to look and see maybe what are the key risks around you. Straight from campus, maybe first job, you don't have too much maybe money to put towards premium. So the key thing is to sit down with your preferred financial advisor and just look, I want a life policy. Take me through the different types of life policies and we see which one is ideal for me. And it's not even maybe a young thing. For example, now I go back to our legend. After his passing, now we see he had a wife, he had parents. Like when I saw the dad talking on the TV, I was getting so shocked, by the way. because just the hopelessness of the whole situation, you could tell that child was about to change that family. You get? So sometimes it's not even about age. There's a 24-year-old who is literally borderline, like what we would call ripe for life insurance. Like they need it. They have financial dependence. They have parents who depend on them. They have a spouse. There's the other 24-year-old who is, maybe the parents are doing well, their siblings are doing well, life is all about them. So two policies for the two people could be very different.
Okay. So then the other question, which was more prominent, is now when someone says, yes, I'm willing to take life insurance policy, I'm interested in it, but then what happens if I am unable to meet my premiums? Because we all know life happens and the cost of living in Kenya is high. So what happens on that point, which is that, yes, I committed to 10,000, but now I've lost my job and I cannot be able to meet that 10,000 because now that 10,000 is going to meet other important things at the moment. So what happens in that point when I'm unable to meet my premiums?
So number one, your life policy needs to be a priority expense. That thing of actually my 10K is going to meet other important things. That's where we start failing. Your life cover. Maybe have you ever noted that when things get tough, you lose your job, that's also when your health decides to deteriorate. That's actually the time when you need life insurance the most. I keep hearing people saying, my money is tight. I don't have room for life insurance. So this is a family person. You're walking through the need for life insurance and they're saying their money is tight. And I like to say that is when you need the life insurance the most. Because if money is tight right now when you are here, can you imagine what that would look like for your family when you are not there? It will be tightest, by the way. But let's answer that question. It's a good question, Lynette. Please start, I like to say, start where you're comfortable. Don't overpromise. Number one, your life insurance premiums need to be factored in your emergency fund. It's my hope that even as you're exploring life products, you also have your money market running and you have set up your emergency fund. And within that emergency fund, you've already factored in all your expenses for month on month, right? So your life premiums need to be there, by the way, in that emergency fund. Number two, I'll tell you, for more mature investors, one way that I see them do is they will buy maybe an investment such as a bond, okay? And then they will match that bond. It will be maybe like a 15-year bond or X number of years bond, and they will ensure the coupons coming from this bond are what pays the premiums biannually, okay? So there are even people, I'll meet and they'll tell me, Charlene, I have rental income of X, or maybe I have an Imajenga, I have a like apartment somewhere, and I want to dedicate one or two of them towards the life cover. Maybe I rent them out for 15K, so nifanyie quote 30K, I see what that would give me. So there are people who already have done that, where they are able to look at, have this like source of income, it's rental income, it's bonds income. Okay, I get them this much, and now they actually dedicate that income towards, the life insurance premium. But for those who are younger and we are yet to get there, number one, ensure that your life insurance premiums are factored in your emergency fund. And please, let's put it in our head that our life insurance premiums are a priority expense. Last year, I got so sad because one of my colleagues in the business passed on. We lost him. And the saddest bit is, I remember when we talked of the importance of him taking a whole life cover. And literally, like I encouraged him to buy it. Yeah, you get, like I was just showing him. But I remember that gentleman used to be so kind to me. Kitambo, before I got a car and I used to live in Kino, he used to give me a lift to town in the morning. Like, namgot. So back then I used to work in KCT, so you'd take me to work like pretty much in the morning. And I remember when he spoke about the whole life cover and he was good and he started this. Then I came to realize that 2 months into the policy, he actually lapsed. And I think that hurt me so much. Like I was so sad. So please, let's remember, even when times get hard, your life policy premiums need to be a priority expense.
Okay. Thank you for that. So the other question, which I've also seen Vincent Mima asking on the wall, is how can I choose the right life insurance cover? What should I look out for? You know, the way we say, like, when you are choosing medical insurance, these are the things that you need to tick and see. What about now life insurance? You've talked about life insurance, but what are those things that we need to, like, when someone approaches us, what are those things that we need to tick out to see that, okay, this one meets that criteria?
So the right life product, this conversation needs to start from a point of needs analysis. Okay, so by now we've learned the different roles that life insurance can play for you. So already, if your key need is income protection, already that tells you, then I'm leaning towards the first two products you should be thinking of is either term or whole. Okay, then now once you identify income protection, maybe what's the secondary need? Maybe inheritance planning. So already that has kicked term out of the equation. So what, Vincent, I would say, number one, sit with a life insurance agent. What I say is, I see a lot of people saying out there, Nini insurance agents, you're always pushing to sell Aki guy. No. Okay, this is where you say, sasa hata sijui nikuambia nini. But genuinely, yes, our job is commission-based. That is true. We are paid when we distribute a product. But let me tell you, we love this job. Like, we chose to get into this career because we love to make an impact in people's families. But then let me tell you, your life insurance agent soon becomes a therapist, becomes a confidant, becomes your friend. It's not just a transactional thing, okay? And I think we've walked this journey with Lynette for so long, with me as her agent. I think she can appreciate that as an insurance agent. It's not just something where you are transacting. So get a good insurance agent, someone who understands the products very well, preferably someone who is independent, okay? Because with someone independent, they'll be able to show you, they'll be able to tell you if maybe you settle on a whole life product as being the product that will answer your needs best. They'll be able to tell you, company X, company Y, company Z, all of them have whole life products, and this is how the different whole life products compare. So by the time they're telling you, company Y, by the way, has the best, they have their notes down. And always remember, at the end of the day, most of these products remunerate us the same. The commission is the same. So literally, proposing company Y for you is because I also know in the event of a claim, in a market where a claim could take as few as 3 days, like a high value claim could take, you're talking of tens of millions, hundreds of millions, could take as few as 3 days, and still in the same market could take as many as 3 months. Okay, so an independent agent will be able to tell you in terms of a seamless claims process, in terms of the superior product, the company that's more customer obsessed, they'll be able to help, help you pick that out. Okay, so Vincent, I saw there was a question there on which are the companies I would recommend. I usually don't put that out, like like either on my social media or in such public forums, but please let's have a chat, especially in the follow-up sessions. Please, let's have a chat on this. I will, during our one-on-one or on email, I'm able now to recommend that for you properly. Okay, so yes. Lynette, you're muted. Let me unmute you, but I would say is, Vincent, please start, for you to pick the right product, start from the point of needs analysis. I think if you get the needs analysis properly, you identify the right product, you'll be good to
go. Okay. So I think also there's a question that says, how am I able to determine how much sum assured is enough and suitable for me? But I think now this question you've answered from the point of, first of all, when someone approaches you, you have to do a needs analysis to see what is your why, what are you looking to achieve, from this life insurance product. And now you can be able to now do these calculations. They can guide you towards doing these calculations. Then now you can find the sum assured that is also suitable for you. Then the other question was asking, how can life insurance be used as an estate management or wealth transfer tool?
Yes. So for estate planning, okay, I've been very fortunate, especially this year and towards end of last year, I have, because I added estate planning, especially through trusts, okay? I work with the best trust company, like corporate trust company. And so I added that I did a lot of training last year because I felt that you cannot differentiate estate planning and life insurance, okay? And this, by the way, I was introduced about 2 years ago. I got one of my biggest clients, who came and he was taking a life policy of like 156 million, and I had never done anything like that. I was moving from doing policies of 5K, and all of a sudden I had a client paying 255K. I was blown away. And when it came to now doing his paperwork, and now they're asking what are the names of the kids. I had even carried different forms because I needed enough like room to write the beneficiaries. And he said, no, I'm going to nominate my trust. And I think that was the first time I started realizing, oh, trust. Like he had set up everything, he had a fully fledged, an operational family trust. And I'm happy. So from last year, I've actually also gotten into that. I did a lot of training from last year. And I get support for those of you who've engaged us on Matters Trust. I get support from a lady, a very pleasant lady called Susan Matenge. But where especially life insurance falls within estate planning is number one, just how fast it injects liquidity into your estate. Okay, so we are talking, so in a trust, or within your plan, you probably have what? You have real estate properties, maybe hata kuna manyumba, there are bonds, investments, that are due to mature when, and maybe you're not looking for them to be sold in the secondary market yet. And even for them to be sold, the process that would need to go through in most cases, then maybe there are shares also within that estate. Then there's the life insurance. And life insurance tends to be the vehicle that's liquidated the fastest. Because as we've said, payouts for life insurance can be made in as little, like as quickly as 3 days, 72 hours. Okay, so one, life insurance injects liquidity into your estate immediately. So even if there are expenses, kama maybe ni shamba now that needs to be moved maybe to your child and you need to pay stamp duty, and maybe it wasn't even, say, in a trust, because you see now those are some of the advantages that you would get to enjoy if this was within a trust. Okay, but if this property was not in a trust, and now you want to transfer, like there are transfers that need to be done, maybe to the rightful heirs, the injection, the capital injection, from the life insurance policy or payout will be able to cater for that. Any inheritance tax that needs to be done. Sometimes the family even needs to go to court. Have you seen instances where a young widow maybe has been left behind and now she's being bullied, by maybe the extended family or by the wealth that's been left behind? You see, the beauty with the life insurance policy is that life insurance supersedes probate. Whoever umeandika kwa hiyo form as your beneficiary, if you've written your husband, there is nobody out there who can come and try and take that estate from your husband. If you've written your husband, you've written your children, those are the people who that money will be paid out to. Nobody can run to court and say they were the rightful beneficiaries. No. Like whatever you've written on your life insurance form is the final, beneficiary. Unless maybe those beneficiaries are no longer there. Okay, kitu kama hiyo. So that already tells you that in a setup where maybe your surviving spouse is even having maybe a hard time and has to go to court to battle, maybe even for part of the estate wealth, then there's already money that's been injected into the family or into your household to allow them to do that. So A life insurance policy would say is invaluable when it comes to estate planning. Sorry, Lynette, it seems I need to unmute you again. I don't know why it keeps muting you. Sorry about that.
Okay, okay. That was even the last question, unless someone has a question on the chat.
Yes.
No, okay.
So Vincent, I hope we can have the conversation after this, just to talk maybe of the recommended firms. There isn't really per se, not every company is best in all lines of business. So first we would need to identify which plan maybe you're talking about. Once we do the needs analysis, then at that point we are able to recommend that company X has an advantage to this type of product, and this is how it compares maybe to the other top two I would recommend. I'm so grateful to everyone who joined. I also want to acknowledge Irene. Irene, I even saw your, you sent me a screenshot. Okay, dear, you are, then I will extend this to the top four. So that's Betty, there's also Leonard, there's Margaret, and Irene. You have my number. Please chat me on WhatsApp so that we may organize how we will get the merchandise to you come next week. Okay. So Lynette, thank you so much for putting this together for us. It's always a pleasure amplifying financial literacy, amplifying insurance literacy. So what I would request is, as a parting shot, if you could enlighten us on how we can join the Money Village and what we are doing at the Money Village. What is the Money Village? And probably how those who are participating in today's masterclass and are not Money Villagers, how they can be part of the Money Village.
Okay, thank you so much, Charlene, for that. So this webinar has been organized by a community over on WhatsApp. It's called the Money Village, where we just have conversations that revolve around finances. Things like life insurance, things like medical insurance, things like personal finance. We also talk about the current affairs that are happening in the Kenyan market, because some of them we don't even understand. So people chime in and help us also understand what is happening in the Kenyan government and that. So for those who've joined on this call and are not part of the Money Villagers, when I'm sending out the feedback form and also attaching the video for today, attaching Charlene's contacts if anyone needs her, I'll also put a link for you to join the Money Village so that you can also join and also be part of this community. This is our first session of today. Then we have a next session on the 2nd of March for International Women's Day. That is a physical event. It's called Invest in You. So we are mainly focusing on women and just enabling them to invest in themselves. So we have different activities. And one of the activities is flower arrangements, because I know women love arranging flowers. Then we have also a couple of events that are coming up in the month of March, which will also roll up a calendar, and you can always join. Yes. So thank you so much for everyone who's joined. Be on the lookout, or by end of day Tuesday, you should have received an email for those who've joined with all the details we've discussed here today.
Okay, lovely. And before we go, I've seen Bridget asking, I know the use of life assurance and life insurance interchangeably are both the same, but let me know, me and my English. So let me try differentiate life insurance and life assurance. And yes, I tend to use them interchangeably, but they are slightly different. So when you talk of life assurance, these are products that are already assured, like you are sure the payment must be done. So you'd be talking more of the endowments that actually have like a maturity, guaranteed maturity payout, as long as you pay your premiums. Whole life policies, those are also life assurance products. Now, life insurance is more like the term policies you get. So yes, you have your insurance, but if maybe you get to year 10, you take a 10-year term and you're still alive, then no payout. Okay, so there's usually that small distinction, but yes, we mostly use them interchangeably. When I talk about life assurance product, life insurance, but in most cases, I mainly use life insurance. Okay. So Patrick asked, what are your consultation rates? By the way, mimi najivunia, I never charge for consultation. And I know it shocks people. No, 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 no. I do not believe in adding a barrier of entry to this knowledge. I do not want someone out there to say, now Mama Bima charges 2,500 for 15 minutes or 30 minutes. I don't have a way of, and that's why you find even on my social media, I love to educate. And I don't charge even for these master classes. This is my second master class this year. Last month we had on retirement planning. It was free. This one is free, and I intend to keep basically most of what I do, especially these platforms of doing financial and insurance literacy, free, because one, I am an insurance agent, and I appreciate that. So I'm able to earn on commission. When I distribute a product, when you interact with me and you feel and you honor me with the opportunity to be your agent, I actually earn a commission on that. So you see, by me charging you to consult with me, then you give me business. I mean, it's a double charge. Like, it doesn't make sense. So, or at least, no, it's not, we don't have, is it even getting too rich? That would be, it's madness. But anyway, so that's why consultations here at Mama Bima are free. You can always book my calendar. Anytime you go to my social media, you'll find my link tree there, and you'll get an opportunity to book a consultation. My consults are free, whether they are virtual. Maybe the only time it will cost you something is if we meet maybe in a cafe and you're having a cup of coffee. If you're in a position, you can pay for it. If not, mimi bado ni mama yao, I can still pay for it. So yes, Patrick, consults are free. Claire,
Okay.
thank you so much. I'm so happy to see you in today's session. Yes. Okay, so happy to have you in today's session. God bless you all. Thank you for staying to the very end of this call. I think at the peak of this call, we had like 90 something of us. Oh my God. Super claps for all of you. That tells you people are interested to know more about life insurance. So let's push protection. Okay, let's ensure we stay protected. Let's ensure if we have financial dependence, we stay protected. Let's also ensure that we also cover our income from, all these critical illnesses, disability, even if we are yet to have any financial dependence. But God bless you all, and I wish you a blessed weekend.
Bye.
I can stop recording now.